The strong returns enjoyed by financial markets this year are surprisingly good, given the economic backdrop and the extraordinary events which have characterized 2016. Many market participants expected a quiet year, but in fact, nothing could have been further from the truth. From the viewpoint of the global economy, the outlook for 2016 was tame, to say the least. Growth in the major economies ground slowly higher, inflation was notable by its absence, and monetary policy was expected to remain accommodative, with the exception probably of the Fed, where further increases in interest rate were expected. However, markets were extremely nervous, and the biggest fear was the threat of currency devaluation by the world's second biggest economy, China. Indeed, the Chinese stock markets triggered global panic in the first few weeks of the year. At the end of February, the governor of the Bank of China stated that there is no need to devalue the renminbi, and the market settled down. The most outstanding feature of 2016 has been the market's response to two great binary events, namely the EU referendum and the US election. In both cases, the result was the opposite of what was predicted by the polls, and the market responses were sharp and logical. The Brexit shock was largely felt in the currency markets, as the sterling collapsed, hitting 30-year lows against the dollar. This, in turn, boosted U.S. equities, as over 70% of the turnover of these companies is earned abroad. Yields outperformed as the Bank of England cut interest rates to record lows. By the end of the third quarter, sovereign bond yields touched record lows, and major equity indices had hit record highs, an astonishing outcome for a year with such inauspicious beginnings. The US election in early November brought a further reset, as Trump, the outsider, cruised to victory. The detail of his eventual policies has yet to be confirmed, but his intention is clearly expansionary. So it appears 2016 may have ultimately brought the end of the age of austerity, as the baton for economic stimulus is passed from central banks and their rather exhausted-looking monetary policy to governments with their plans for fiscal stimulus that might improve growth and trigger inflation. Equity markets have moved higher, bond yields have backed up, and US dollar index has risen steadily to levels last seen in 2003. So as this remarkable year comes to an end, sterling investors will be glad to have gone through it with such a strong returns. 2017 no doubt has more surprises in store as Trump policies take shape, emerging markets respond to possible trade tariffs, and a series of European elections may eventually spell the beginning of the end of the Euro project. In such context, our message remains consistent. It is always best to remain diversified in your investments and avoid giving too much importance to short-term performance.